Welcome back, my passive income investors alike, to my largest dividend stock holding being my favorite REIT, of course, in the Great White North, being Riocan. And they posted earnings that were rather abysmal at a glance, and I thought it'd be appropriate to go over them today because I've been digesting it. And no, I'm not a genius. I might be overlooking stuff. So if you could help me out and let me know if I missed anything in that comment section below, it'd be highly appreciated. And while you're down there, consider hitting that like button, folks. But let's just take a look at the stock here, guys, which has been on a nice steady incline since the beginning of the year. You know, it's been a nice uphill truck battle, but all in all, we're still not back to all-time highs, and we're going to see, does it deserve to be over $20 a share here, folks? I mean, I made a price prediction that this was an $18 to $20 stock when we were buying it for $15, and here we are blowing past that prediction into a full-blown recovery, which I didn't think was going to happen, at least to the latter half of 2021, because in Canada, unlike the US or Europe, we've been on and off lockdowns. In fact, while I'm making this video late this evening, we're full lockdown right now. We're not even supposed to be leaving our homes here, folks, but let's get right into this by looking at the numbers first, and then we're going to get into the actual presentation, which offers a lot of juicy details. Now, to make this as clean as possible so you guys don't get frustrated, I'm going to make sure my head's above these earnings, and taking a look, the net income is all I care about, because if we look at the funds from operation per unit, the money that they brought in per unit was 36 cents against Q1 of 2020 here, where they brought in 46 cents. Is a pretty drastic difference here, folks. But when we look at the actual net income, it increased year over year. So this is an actual really good sign. And if we ask ourselves, well, where the heck did all that money go? We can scroll up and they mention it right at the beginning of this earnings report. Sorry, it's a little glitchy there, but it does say that basically that they impacted by a 5.8 million one-time G&A cost.
Hold up, wait a minute. I'm a moron. I didn't figure out what G&A stood for, and it hit me like a bag of bricks. General and administrative. And if we scroll down to figure out where this big impairment charge came from, it turns out that the one-time $5.8 million general administrative expense came from an accelerated expensing of certain unit-based compensation costs. Somebody's getting compensated in shares, and I don't know why they're doing it earlier and it's accelerated. I'm not sure what the deal is with that, but it counted for 0.02 for the funds from operation, those 2 cents. That adds up, baby. That adds up when you got millions of these things outstanding. And it also decreased while lower residential inventory gains and lower lease cancellation fees, partially offset by a lower pandemic-related provision, accounted for the remaining changes. So at least we are through this.
So unfortunately, they have some kind of G&A cost. I don't even know what that exactly stands for, but apparently that's where a lot of the funds this quarter went to. But I'm glad to say at least the rents are remaining stable, because if we scroll down to actually take a look, I made a bit of a price prediction that I said if Riocan was receiving less than 85% of the rents, I was going to be a concerned shareholder. However, from Q2 of 2020, when they were only getting 89% of rents, they're now collecting 93.9%. Now, these rent collections don't really impose the reality of this pandemic, because in May of 2020, I believe the rents they collected was like in the 70%, but over the entire month, they were able to balance it out, which we can see some of this is deferred rent payments. Luckily, it's nothing at this point, not a lot of deferrals. Provisions in rent abatement and bad debt is equaling at 2.4%, and the remaining rent to be collected is at 3.2%. And I trust the remaining rent to be collected because those are usually people that will pay in the following month. It just hasn't got applied to the balance sheet here, folks. But what can we learn from this earnings call? Let's get right into the presentation, folks, because there's a lot of cool stuff. Now, you might recall I posted a Riocan video like a week or two ago where I was standing right at this location because they're hopefully going to build a $2 billion park over this railway, and this is going to be the largest downtown mall. It's going to be probably like the nicest place in downtown Toronto to visit. I'm thinking about even renting an apartment there, folks. I bleed that Riocan. You know it. Taking a look, guys, we saw the rents already. They do have 30 million in security deposits. Not that that's much for a multi-billion-dollar REIT, but they're using it to cushion, kind of offset rents that they're owed in the future. So that's kind of nice on that end of it, folks. Just taking a look at the blended leases. You can check that out real quick. Not the most entertaining highlight. More impressively to me is the NOI. The FFO per unit in the same property NOI has been increasing, but it has generally been decreasing, obviously. But luckily from Q4 of 2020, we're seeing an improvement in the same property net operating income. So it's kind of nice to see that they are recovering, and more cool than not, here we can actually see how they're adjusting their audience, which are their rental tenants, which is beautiful stuff. Let me zoom up because I don't think you guys can see this with my head in the way. But just take a look at this, because they actually increased by 20 basis 20 basis points over 2020 in essential personnel services. Now they have grocery encored centers make up 42.5% of the total tenant basis, which is just unbelievable, because we heard that the CEO going into this, we're basically going to swap out as many bad tenants as they had with as many like foundational tenants, Shoppers Drug Marts, your LCBOs, your grocers, like we can see here, guys. And we can see that they dropped 20 basis points for apparel year over year. But the funny thing is you can be like, hey guys, we got rid of some apparel. Well, they got rid of themselves. It's not like you had to put a big shiny green arrow on here and say, hey, this is a good thing. Should make that a red arrow. It's not a good thing here, folks. But just scrolling on, just taking a look, the rent collected by tenant basis. So 79% is the strong, stable tenant. And obviously we still have some of the finicky stuff when we're looking up here with the apparel, the movie theaters, the quick service restaurants, et cetera, folks. But where I'm most intrigued is obviously in the Riocan living, where they got a steady rent collection of 98% from the residential units for Q1. And we can see a lot of these are still uncompleted as well, because I think this one says that what they got a 21% lease, this one's 74% lease, this one's 99, and this one's 85, and they sold 50% non-managing interest at a 3.6% cap rate. But this is like the part of Riocan that I love the most, is seeing the residential come online, because this is where the stability of that dividend income from my early retirement is coming in the future, folks. I got over 30 grand in this stock. I know to some people that might be either a huge amount or a tiny amount, depending on what spectrum of your investing journey you're on. But to me, that's a lot. It's like 12% of my entire portfolio. So Riocan development focused on mixed-use residential, guys. So obviously this is what I keep telling you, that Riocan is building the future of real estate with offices, residential units, and then massive malls on the bottom. They're going to be cities and towers. It's going to be a marvel to look at, an awe-inspiring moment, folks. Now, I've talked about this many times. Here's I took some videos of this. This building is just massive, massive, massive stuff. But more, let's just scroll to the bottom here and see if we can find some more interesting information. Unlike most REITs here, folks, one thing that I want to point out is I own Stag Industrial, which does acquisitions by diluting shareholders. This is another thing that I love about Riocan, is that they're basically funding their entire development pipeline through free cash flow, divested proceeds, strategic partnerships, and faster capital recycle from condo, townhouses, and developments. So this makes me feel better, because I know that they've actually been really good at not diluting us as shareholders. I know it kind of finickies around a little bit, but it's nothing like a Stag Industrial, which is a U.S. REIT, so it's kind of uncomparable nonetheless. They have alternative sources of income and cash flow for providing efficient capital recycling. Taking a look at the condo townhouse development, folks, these are some other huge properties, especially this 11 Yorkville one, and I can't believe it's 99% of the 586 units are pre-sold. I mean, they're pre-sell across the board. Absolutely incredible here. So like I said, every time I get into this Riocan discussion, guys, I always feel better and better about owning this. It's a really good foundational REIT. I don't pay any foreign income tax. And guys, it's Riocan. It's Riocan. I mean, I probably missed a few things here, but this was just a really quick earnings report, and I had to dig through it, because when I look at those FFO, those earnings per shares, and they're that terrible, get a little concerned, but luckily it's not directly reflected from non-paying tenants. Their tenant payers are going up. That's all that matters. Better than the year prior, even considering the first quarter of 2020 was when the pandemic hit in March. So they roughly had a full income production in Q1 of 2020. And now they're back to that, even though we're in a lockdown right now, folks. So in light of this, it's going to be very rocky moving forward. I think they do a good job at maintaining the balance sheet, but like every REIT, I just want to wait till we're fully on the other side of this pandemic and then see what the earnings look like moving forward from a really solid open quarter, because that's really going to reflect where we stand and where the damage has been done. So in the clarity of my transparency and all the wonderful homework I do, I just want to pass the question off to you. What do you guys think in that comment section below? Let me know. Stay cool, stay awesome, and I look forward to catching you tomorrow.